in this segment, we're talking about how to legally minimize your income taxes. And this is a game changer because for most people, taxes are their biggest living expense, but not for wealthy people, right? Because wealthy people have mastered the skill of minimizing their income taxes through wise planning. And as a side note, there's a big difference between a poor mindset and a wealthy mindset, right? A poor mindset only plans for the weekend, but a wealthy mindset plans for multiple generations, right? Have you noticed that? Wealthy people always plan ahead. Have you noticed that? They plan ahead, they strategize, they make wise moves, especially when it comes to minimizing their taxes. And so, and you know how I am. As I'm learning, I want to share everything, right? Because it's so true how we rise by lifting others. And so everything I'm learning, I'm sharing with you. I'm very transparent. So one of the major keys to building financial wealth is learning how to minimize your taxes. And so right now, I'm going to give you 5 practical tips to minimize your taxes. But quick disclaimer, this is for educational purposes only, right? And so before you make any major decisions, please consult with your advisor, your tax accountant, your lawyer, right? And now let's jump right in. The first tip is this. First tip is to understand how taxes are calculated. That's important that you understand how taxes are calculated. So the big thing about this is that you have to really understand that tax brackets, the tax brackets are not based on your total income. They're based on your taxable income. And so the key to minimizing your income taxes is to minimize your taxable income, right? Now, up here, and I know it may be hard to see the screen, but on the Facebook, I'm gonna post this whole whiteboard later. But basically, I have up here is the 2023 federal tax brackets for single filing status. Of course, there's different filing statuses, but if you file as a single, if you file as a single, these are the tax brackets, right? So these numbers will be different, based on how you file, based on your filing status, right? But anyway, so for the single filing status, you see from 0 to 11,000, the rate is 10%. Then from 11,000 to 44,725, the rate is 12%, and so on, right? These different each tax bracket has a different rate, right? A different rate. Now, to really understand how this works, let me take you through an example. Let's say, let's say your taxable income is $50,000. Okay, so then what's going to happen is the first 11,000 will be in this first tax bracket, and so 11,000 of the 50,000 will be taxed at 10%, and then you go into the second tax bracket, right? And so between 11,000 and 44,725, so that's 33,725 that would fall into this, right? If you have a $50,000 taxable income, right? It's going to fill up this bracket, right? So that's 33,725, and in this bracket, it's going to be taxed at 12%, right? So 11,000 will be taxed at 10%. 33,725 will be taxed at 12%. And then we still have, leftover we still have an amount left over of 16,275, and all of that leftover amount will fall into this third bracket, right? And so that 16,275 will be taxed at 22%. So do you see here how your whole $50,000 of taxable income is not taxed at the high tax bracket rate, only the portion that fits into that particular tax bracket. You see what I'm saying? So of the 50,000, 11,000 is taxed at 10%, 33,725 is taxed at 12%, and 16,275 is taxed at 22%, right? That's how taxes work, right? So So the key, as I said, so the key is, so the key to minimizing your income taxes is to minimize your taxable income, right? Because really, look, if you can get that taxable income down to zero, then you will not have to pay any federal income tax, right? Because it's all based on your taxable income. It's not based on your total income. It's only based on your taxable income. So the key is, so really the key question, right? When we're talking about how to minimize our income taxes, the key question is this: how can I minimize my taxable income? Because if you minimize your taxable income, you automatically minimize your income taxes, all right? So the first tip is to understand how taxes work, right? Understand how these tax brackets work. The second tip is this: take advantage of Section 162A of the IRS tax code, because Section 162A allows a deduction for any ordinary and necessary expenses paid or incurred during the taxable year in carrying on any trade or business. So when you start a business, you immediately are given the opportunity to take advantage of Section 162A of the IRS tax code, which allows you to take a deduction for all of your business expenses, all of your expenses that are related to the carrying on of your business, right? The operation of your business is a business deduction, right? Examples include advertising expenses, car expenses, right? Contractor labor expenses, legal and professional services expenses, supplies expenses, travel expenses, home office expenses, cell phone expenses, training expenses, and the list goes on and on and on. This is a big thing. And so, I really believe that even if you have a regular job that you absolutely love, I believe that everyone should have at least a side business, because once you start a side business, you immediately are given the opportunity to start to take these business deductions, right? As long as it relates to the operation of your trade or business, right? So, do you see how the moment you start a business, a portion, even a portion of your personal expenses can be reclassified as business expenses? And business expenses decrease your taxable income, which decreases your income taxes, right? So that's huge. That's a game changer. Because think about it. You start a side hustle, and then now a portion of your car expenses you can write off, right? Through the there's different ways to write it off. Where one of the common ways is keeping track of your business miles, and then applying the IRS rate to those business miles, and you can take that deduction, right? And so now you're able to write off a portion of your car expenses, right? And think about your home, right? The moment you start a business, now you could set up a room in your home to be designated as your home office expense, right? And of course, there's different regulations because it has to be set up properly, right? And all that, right? But you set it up, and then now a portion of all of your housing expenses can be written off. Even if you rent an apartment, you know what I'm saying? Like it doesn't even, this can be taken advantage of, if you own a home, but also even if you don't own a home, even if you're renting an apartment, or even you're renting a room somewhere, you know what I'm saying? Like, you can still take advantage of writing off a portion, the business portion of your home expenses as a deduction, right? Um, and there's so many other examples, like you go on a vacation, right? And you go on a vacation, but if you have a business purpose for that vacation, right? Like if that vacation also has a business purpose, like maybe you're going to some business meetings, or you're going to a conference, or you're going for some training, or you're going you know, like to do some research for your company. I like these all these different types of like purposes. I mean, like there's many different types of business purposes that would qualify for you to actually deduct a portion of your vacation as a business expense, right? Because remember, section 162A says, you know, if it's ordinary and necessary, right? And if it's related to your business, right, you can deduct it, right? So it's amazing how once you start a business, you open yourself up to be able to, you know, take business deductions, right? Your cell phone, right? A portion of your cell phone expense now can be written off, right? The portion that you use for your business, right, can be used. Your computers, you know, and online courses, all of that, it all can be a write-off, right? Which decreases your taxable income. Of course, it has to be done correctly. You have to have documentation and all that stuff, right? So the first tip is to understand how taxes work. Second tip is to take advantage of section 162A of the IRS tax code. And now the third tip is to take advantage of the fact that long-term capital gains are taxed at a much lower tax rate than ordinary income, right? So for example, for 2023, long-term capital gains tax brackets for a single filing status is, so if your taxable income is under 44,625, then you do not have to pay any long-term capital gains tax. Do you see that? It's 0%. You know, if your taxable income is below 44,625, it's 0%. If it's between 44,625 and 492,300, then your rate is 15%. If it's above $492,301, then it's 20%. So this is amazing. Now, keep in mind, this is for long-term capital gains. If it's short-term capital gains, meaning if you held the asset for less than a year, right, which would be like short-term capital gains, then that is taxed at ordinary income rates, right? Taxed at ordinary income. Big difference, big difference. So you want to keep that in mind, right? Well, you know, like when you're investing, if it's long-term capital gains, you're going to benefit. You're going to benefit a lot from these favorable tax treatment. You know. And by the way, do you see something here? Do you see how the tax code, the IRS tax code, is designed to benefit business owners and investors, right? That section 162A of the IRS code, that's a huge benefit for business owners because people that work a W-2 job, they can't take advantage of that, right? Unless they have a side business, you know? But like once you start a side business, you can take advantage of it. Once you become a business owner, because the IRS code favors business owners and it favors investors. Because look at this. I mean, look at this long-term capital gains tax brackets. I mean, these are very low rates. And so that is so you want to take advantage of long-term capital gains, right? So first tip is understand how taxes work. Second tip is to take advantage of section 162A of the IRS tax code. The third tip is to take advantage of the fact that long-term capital gains are taxed at a much lower tax rate than ordinary income. And now the fourth tip is this: take advantage of retirement accounts. Retirement accounts. Now, there's different types of retirement accounts. And depending on your situation, right, depending on your tax situation, you can find the type of retirement account that really fits your situation, right? There's a lot of nuances to it, but here's some general concepts, okay? Number one is this: if you do have a W-2 job that offers you like an employer-sponsored 401k plan, right? And if they're matching, if they have like a matching program where they will match your contributions up to a certain percentage, make sure you take full advantage of that because that's free money, right? Um, And if they don't match, though, most likely you should probably not even participate at all if they're not matching. Because what I found is that with a lot of these employer sponsored retirement plans, there's a lot of hidden fees, a lot of admin fees and stuff. And what I found is that you're better off if you do like a Roth IRA or even a traditional IRA, depending on your tax situation. You know, better off doing that than an employer sponsored retirement plan if there's no matching. But remember this: if there's matching, take advantage of that matching because that's free money, right? So you want to look at different things. And like, for example, the difference between like a Roth IRA and a traditional IRA, right, is that like with a traditional IRA, which stands for individual retirement account, right? With a traditional IRA, you are able to deduct the contributions that you make to your traditional IRA, right? So that will lower your taxable income, which is good. But the thing about the traditional IRA though is that um, when you reach retirement age and when you start to take out, some of the money from the traditional IRA, you're going to be taxed. You're going to be fully taxed on the money that you take out, right? And so the other option is a Roth IRA, right? And the thing about the Roth IRA is that although you are not able to deduct the contributions into you are not able to deduct the contributions that you make into a Roth IRA, although you can't deduct it now, but when you reach retirement age and when you are starting to take out some of that money, all that money is tax free. So it grows tax free. And when you start to get the distributions, when you start to take distributions from the Roth IRA, it's also tax free. So it's Roth IRA is amazing. It's amazing. So I mean, in general, like if you are kind of like early in your career and if you're not in a super high tax bracket right now, right, then you might want to look more into a Roth IRA because maybe the Roth IRA might suit you better. But if you are in a situation, maybe you're like a doctor or a lawyer and you're making a bunch of money and you're like, in a super high tax bracket, then maybe the traditional IRA would be more beneficial to you, for you to get that deduction now, So you just have to weigh it. But for the purposes of this segment, um, retirement plans is something that you want to take advantage of, but you just have to do your research to find out which type of retirement plan is the best for your situation. So the first tip is to understand how taxes work. The second tip is to take advantage of Section 162A of the IRS tax code. The third tip is to take advantage of the fact that long-term capital gains are taxed at a much lower tax rate than ordinary income. The fourth tip is to take advantage of retirement accounts. And now, the fifth and final tip for today is this: take advantage of HSAs. HSAs. That stands for Health Savings Account, right? HSAs. So HSAs they are a type of account where you put money into this account and the money is designed for you to use to pay for future medical expenses, right? Medicines, procedures, doctor visits, whatever, it's designed for you to pay for medical expenses. Now, the great thing about HSAs is that the money that you contribute into a HSA, it's tax deductible, right? So it's gonna lower your taxable income, right? So that's good. And also, when you take the money out to pay for medical expenses, that's also tax free as well, right? You're not taxed on it, right? So it's a very powerful tool. But look into it to see if you even qualify to have an HSA. Normally, if you have a high deductible insurance plan, then it might be a situation where you are able to easily open up a HSA account, right? And there's different types, and like there's even other types of like accounts that are kind of similar to HSA, but we won't go into all that for right now. But for right now, for this segment, look into the HSA to see if that would be of a good fit for you, right? So those are five, So number one, first tip is understand how taxes work. Number two, second tip is take advantage of Section 162A of the IRS tax code. Number three, third tip is to take advantage of the fact that long-term capital gains are taxed at a much lower tax rate than ordinary income. The fourth tip is to take advantage of retirement accounts, right? Look into which retirement account would be the best fit for your tax situation. And the fifth tip is to take advantage of HSAs. All right. If you have any questions, feel free to reach out to me.